Ever wondered about the difference between subsidized and unsubsidized loans? Well, you're not alone. These two types of loans are like two sides of the same coin, both crucial in the world of student finance. They serve as a lifeline for students, helping to cover the cost of education. They're both types of federal student loans, but they have some key differences. One of the major distinctions lies in how interest is handled while students are still in school. Subsidized loans and unsubsidized loans, while similar in some respects, have unique features that can make one more appealing than the other, depending on your financial situation and needs. But before we delve into their specifics, it's important to understand that these loans are more than just borrowed money. They are investments in your future, a stepping stone towards achieving your educational goals. Now let's dive into the specifics of these two types of loans, starting with subsidized loans. Subsidized loans are need-based loans where the government covers the interest under certain conditions. Subsidized loans are a kind of financial aid provided by the government, specifically designed for those in need. They are need-based, meaning you must demonstrate financial need to qualify for these loans. This is determined by your free application for federal student aid form, commonly known as FAFSA. Now, the unique thing about subsidized loans is how the government handles the interest. For most loans, the interest starts accumulating from the moment you receive the money. But with subsidized loans, the government steps in to cover the interest while you're in school. This is applicable as long as you're enrolled at least half-time, but that's not all. This interest-free period extends to the grace period, which is typically the 6 months after you leave school and during periods of deferment. Deferment, for those who are unfamiliar with the term, is a temporary postponement of loan payments, often due to financial hardship. This interest coverage is a significant benefit of subsidized loans, as it can save you a substantial amount of money in the long run. Imagine not having to worry about your loan ballooning while you're focusing on your studies. But there's a catch. The amount you can borrow with subsidized loans is limited to your financial need. This is calculated as your school's cost of attendance minus any other financial aid you receive. In summary, subsidized loans can be a great option for students in need. They offer the benefit of interest-free periods, which can make a significant difference to your financial situation. But remember, they are need-based. So that's the subsidized loan. But what about its counterpart, the unsubsidized loan? Unlike subsidized loans, unsubsidized loans are available to both undergraduate and graduate students, regardless of financial need. Unsubsidized loans are a bit different from their subsidized counterparts. The key difference lies in how interest is handled. With unsubsidized loans, the interest clock starts ticking as soon as the loan is disbursed or paid out. This means that even while you're attending classes, your loan balance is growing due to the addition of interest. This brings us to an important point: the student's responsibility for this accruing interest. Whether you're in school, enjoying your grace period, or in deferment, you're on the hook for the interest that accrues on your loan. If you don't pay it, it gets capitalized. In other words, it's added to the principal balance of your loan. So in essence, you'll end up paying interest on your interest. The amount you can borrow in unsubsidized loans is determined by your school's cost of attendance, minus any other financial aid you receive. However, there's a twist. Unlike subsidized loans, you can borrow up to the annual and aggregate loan limits regardless of your financial need. Taking out an unsubsidized loan is a significant financial commitment, and it's crucial to understand the implications of not paying interest during your school years, your grace period, and deferment periods. That covers the unsubsidized loan, but how do these two types of loans compare? In summary, both subsidized and unsubsidized loans have their unique characteristics and benefits. Subsidized loans, with their government-covered interest during your school years, are a boon for those demonstrating financial need. Unsubsidized loans, on the other hand, offer wider accessibility to both undergraduate and graduate students, albeit with interest accruing from the get-go. For undergraduate students, you can't borrow more than $5,500 freshman year, $6,500 sophomore year, and $7,500 junior and senior year. It helps to prevent overborrowing and reduces the burden of repayment in the future. It's essential to weigh these options and borrow only what's necessary for your education expenses. Remember, understanding your loan options is key to making smart financial decisions for your education.